despite the pullback, one top hedge fund manager thinks the S&P 500 is close to overbought levels about the broader markets. Dan Niles runs Niles Investment Management. Dan, great to have you with us. I know you said that geopolitical is not something that you should focus when you're a longer-term investor, but this could provide you some opportunities to buy in the market. So what are you sort of looking at if we do see a prolonged risk-off sort of trade?
Well, we've been writing for a while with the headline, "Don't fight the Fed." And today I sort of changed that to "Don't fight the Fed" and potentially the PBOC, which is China Central Bank, because between those two factors, you're likely to have a pretty good move for the next 12 months because it's really been monetary and fiscal policy that's been driving this market really since 2021, right? 2021, oh, it's transitory, market's up a lot. 2022, no, it's not transitory, Fed's hiking, market goes down a lot. They stop hiking in 23, that's up a lot. They're cutting rates in 24, it's up more. And China, which has been the fly in the ointment globally, after 4 years of not willing to do any kind of consumer stimulus, they finally kind of gave up and supported property, banks, and the consumer, which the consumer piece is the most interesting. And obviously, you've seen the markets in China rebound, and they're the second biggest economy in the world. So those are the sectors when you think about it through year end, and you want to take advantage of dividend sectors, so utilities, consumer staples, telecom services, but then you can also be on the risky end in things like biotech that benefit from rates going from 5% eventually to 3%, and things like commodities that benefit from China starting to stimulate finally.
So what are you buying in China? And were you in before the stimulus was announced? Are you even more in since the stimulus has been announced?
Yeah, no, I was pretty stupid in that I was in there for the trade. I kind of gave up on the trade because it didn't look like China was going to stimulate. And I think probably the next day they started to stimulate. But we did have some exposure through commodities, which obviously are benefiting. We do have some exposure through ETFs that we'd want to get bigger in. But, obviously it's up 29% off the bottom. And so for right now, it's up on obviously multiple expansion, like you've seen with Nike today, right? Like it's up a lot because people are hopeful, then the numbers come out and the stock's getting hit. So with China, they're shut down for a week for Golden Week. Have to see how things look, come out of it. But yeah, I want to get longer China as we go forward, because if this is a fundamental shift in their way of thinking, we've seen what stimulus does in every other country on the planet. Unless you think a global pandemic is great for the world, the S&P shouldn't have been up 16% in 2020. So you know what stimulus can already do. And China has just refused to do it. And now they've changed their mind.
The stimulus, though, in China versus the stimulus that we saw in the U.S. are very different in terms of the mechanisms in which stimulus is done. I mean, there's some limited checks being handed out in China. There is still a population issue in China, structural issue. There's still a housing overhang issue, and they're only reducing things like mortgage down payments and rates and things like that. So do you see the uplift to be, do you forecast it to be as powerful as a lift higher elsewhere in the world on stimulus?
Absolutely, for one reason. I mean, the reason we were bullish on China coming into the year was valuations were so incredibly low. And so you only needed something to go right. And then for 9 months, it just, nothing went right and it kept getting worse. And so the valuations is the missing piece of this. You're still much, much lower. You look at a lot of Chinese tech stocks, and they're still, even with this 30% move higher, they're still trading at mid-teens multiples. You've got U.S. tech stocks that are sitting at 30-something multiples. And so you've still got a lot of revaluation you can do. And on a global basis, which is more interesting to me, the Chinese stock market is still fairly low relative to a lot of other regions around the planet. Everything you brought up is very, very true, but that's also why it was where it was at. And we've seen this picture show before where 2014 to 15, you kind of had this surge, and obviously it went pretty far, and everybody's underweight China. Even guys like me who were bullish coming into the year sort of ended up going, well, you know what, I had this view, it's clearly not working, and then all of a sudden it triggers. So I think you have to take a look at it, because this move away from stimulus checks to consumers are welfareism, which is what they believed, to now we're going to hand out direct checks to the consumer. That's a big ideological shift. And I don't think you want to take that too lightly. Obviously, the elections, if Trump gets elected, you might get a pullback, get you another chance to get in. And so that's something else to kind of consider in terms of not piling in right here.
Agree with the structural underweight. In fact, global managers more underweight China than really at any time in their history, and certainly compares to Japan in the 90s. And I agree also the size of the stimulus may be more than people expect here. But so I'd bring it to, how about those companies that kept getting knocked down every time we had a bad China headline? And I do mean the Diageos, the Ultas, the Estee Lauders, the LVMHs, so the luxury segment. And then address that, because I don't know if you're investing directly there, Dan, but how about Apple then? In terms of, again, does any of this play into the China weakness that has plagued so many stocks' performance over the last 6 months?
Well, you have to separate out what was the problem with Apple. Was it China, or was it Huawei coming back with the flagship smartphone? It's the second. It's not the first. And stimulus checks to the poor they're not going to run out and buy an iPhone. So I think you have to separate out some of this. And by the way, over a longer period of time, I think Apple will do well, because I do believe there is an upgrade cycle on driven by AI. But in the near term, you got to look at the numbers coming out, and it doesn't look like the initial uptake was good, probably because the rollout of AI was staggered. So for me, I'm more looking at industrials, commodities, things that are related to the property market, which is absolutely imploded in China, those sectors that people have given up for dead, and not necessarily, an Apple, but things that are in the copper sector, aluminum sector, steel sector in the U.S. that'll benefit if the property market in China finally starts to show some stabilization.